Hi there, and welcome to Calculations and Things. Today we are going to have a look at financial ratios with a specific focus on solvency ratios. Our first ratio we are going to calculate is the inventory turnover ratio, where we take cost of goods sold or cost of sales over our average inventory. Now, to calculate our average inventory, we will be taking the inventory at the beginning of the financial year, so the end of last year, and the end of this year, and divide it by 2. When we look at the statement of comprehensive income for the year 2022, we will be looking at cost of sales, so that's next to the green arrow, which is the 50,881. Moving on to the statement of financial position, we will be looking at inventory. So we have two amounts here, the 8,501 for the year ended 2021, which is the opening stock for the 2022 year. And then at the end of the year, 8,709, which is the end of the year 2022. Looking at the inventory turnover ratio, we have cost of goods sold over average inventory. Remember, the average inventory is calculated by taking the stock at the beginning of the financial year and adding the end of the year amount, divide that by 2. So we took the 8,501, which was the beginning of the year stock, plus the 8,709 at the end of the year, and we divided it by 2, and that's where we got our 8,605 amount. We took the cost of goods sold, the 50,881 in green, divided by the 8,605, which represents the average inventory amount, and we get a 5,91 amount, which means that the stock turnover ratio is 5,91. It means our stock changed, or the turnover rate is 5,9 times a year. When we look at our second ratio, the stock holding ratio, we are looking at how long stock is on hand in relation to purchases taking place, or how long before it is sold. So if you are working for a fish company, you would want your stock to change quite quickly and to be sold on a regular basis because you don't want it to rot. If you have furniture or equipment that can stand in your storehouse a little bit longer, then you can look at a lower stock holding ratio. When it is fresh produce, you want a higher stock turnover ratio or stock holding ratio. So we're going to look at inventory in red divided by cost of sales times 365 to get the amount of days. When we look at the statement of financial position, we will be looking at inventories in red for 2022, which is 8,709. And we are going to look at the statement of comprehensive income, or the income statement, and we will be looking at the year 2022. We look at cost of sales, which will be the 50,881. When we look at the stock holding ratio, we will take our red inventory divided by our green cost of sales, which will be 8,709 divided by 50,881 multiplied by 365 to get the amount of days. So we get 62,47, which means that the stock has a turnover rate, or the holding ratio, is every 62 days. So we hold onto stock a little bit more than 2 months before it changes or we buy new stock. This is really fine if you have a business that sells furniture or equipment. With fresh produce, you might not be able to hang on for 62 days. We're looking for a lower or a quicker turnover time there because it is something that can rot. Number 3, our debtors collection period. This is where we look at the average debtors divided by the credit sales, and we're going to times it by 365 to determine how quickly we collect debt. Okay, so we're going to take our beginning of the year amount plus the end of the year and divide it by 2 to get our average debtors amount for the year. We are looking at the statement of financial position, and we are looking at trade and other receivables, which will include our debtors. Remember, now we have to go and calculate the average. So we're taking our beginning of the year amount plus the end of the year, so that's the 1,277 plus the 1,703, and we're going to divide it by 2. When we look at the statement of comprehensive income, also known as the income statement, we will be looking at our 2022 financial year, and we will be looking at turnover, which is also sales. Now, next to turnover, it has a 35% on credit in brackets. So that's a note that indicates how much of our turnover amount of that 80,067 will be on credit, so that's our credit sales. So 35% of that 80,067 will be our credit sales. Okay, now let's look at our debtors collection period calculation after looking at the financials. There was no space where it said average debtors. So what I indicated to you was the amount at the beginning of the year, the amount at the end of the year. When we add it together and divide it by 2, we get our debtors. So that's where the average debtors amount comes from. So if you look at the calculation, it says 1,277 plus 1,703. So that was the beginning of the year amount plus the end of the year divided by 2. And that's where we got the 1,490. We then divided by credit sales. Now remember, in the statement of comprehensive income, it said 80,067 next to turnover, but there was a bracket that said 35% was on credit. So we are going to calculate 35% on that 80,000, and that's where we got the 28,023 and 45 from. We multiply that after you divided by the 1,490 by our credit sales amount. We multiply that by 365, and that gives us 19.41 days, which is really, really good. On average, a business can collect debt somewhere between 30 and 90 days, depending on their policy. But in this case, our business is doing very well because they are collecting debt every 19 days. So that's at least once a month we are able to collect our debt. So the business's debtors collection period is in a very good space. Let's look at the creditors payment period. Now, normally you want to stretch this a little bit because paying our creditors is an outflow of cash, and we want to delay that process without being charged interest. Again, we have to go and look at the average amount. So we're looking at average creditors, which will be my creditors at the beginning of the financial year plus my creditors at the end of the year. And we're going to divide that by our credit purchases. And we're going to multiply it with 365 to get the amount of days. When we look at the statement of financial position, which is also the balance sheet, we are looking at trade and other payables, which will represent my creditors control. We have 10,211 there, and we have a 9,625. So the one on the right-hand side is the beginning of the year, the 9,625, and the 10,211 is at the end of the year. We are going to add these two amounts and divide it by 2 to get the average. Then we look at the statement of comprehensive income, and we are looking at the year 2022. We're looking at cost of sales. Now, again, there's a value in the brackets. It says 45% on credit, meaning the cost of my goods, 45% of that was bought on credit. So this 50,881 amount, we will have to go and multiply with 45% to find my credit purchases. Now, let's calculate our creditors payment period. We had a look at our average creditors, so that was the beginning of the year amount plus the end of the year divided by 2, and we're going to divide it by our credit purchases multiplied with 365 to determine the amount of days, how long it takes us to pay off our creditors. So if we look at our calculation, the 9,625 in yellow plus the 10,211, which was the creditors at the end of the year, added together, and we get in the next one 19,836. That is the total of my creditors beginning of the year plus end of the year. But now we have to divide it by 2 to get the average. So we're going to divide it by 2, and we end up with 9,918. At the bottom of the calculation, we have the 50,881, which represents my cost of sales. Now that cost of sales is cash and credit, and we have to go and calculate 45% on that because in brackets in my statement of comprehensive income, we had a 45% note that said only 45% was bought on credit. So we're going to say 50,881 times 45%, and that's where we got our 22,896 and 45 cents. We're going to take our 9,918, which represents my average creditors in yellow, divided by my green, which is my credit purchases, and we will get an amount of 158,11 days. So our business is in a really good space when we pay our creditors because we only pay our creditors almost every 6 months, which is a good space to be in. That means we have very little outflow of cash, but our collection period with our debtors in the previous calculation was quite quickly, which means we have a quicker inflow than outflow of cash. So our business is in a really good cash flow position. Calculation number 5 is our fixed assets turnover ratio. This is where we take our turnover or our sales and we divide it by our fixed assets. And this is used to determine the efficiency with which the operating assets are utilized to generate income or our sales. We are going to have a look at the statement of comprehensive income. We're looking at the year 2022 and we're looking at the turnover or the sales amount, which is 80,067. Then we move on to the statement of financial position, and we are going to have a look at our non-current assets in blue, which represents, in the year 2022, 39,953. Looking at our calculation, we have our sales amount in pink, which is the 80,067, divided by our fixed assets, which was 39,953, and we get 2. Rounded off to 2. The ideal is 2.5 or more, but 2 is a very good space for the business to be in. So we can say that we are effectively using our assets to generate an income. And that is the end of our calculations for today. Make sure that you subscribe to Calculations and Things for more videos.